Hello, and a massive hello to everybody. How's everybody doing? Rocking and rolling in a free world. Here we go, 50 pips in the house. 19th of November, 2017. Here we go. No trade calls and recommendations. Every response for their own stuff. We're here for educational purpose only as we head into this shortened trading week. So again, we're going into this shortened Thanksgiving trading week. Keep in mind that basically markets are closed on Thursday, half-day trading on Friday. Now, in these weeks, and especially also in the Thursday, Friday period, in the past, I've seen very, very big moves. I've seen a lot of chop, a lot of snooze fest. Bottom line, the way we tend to look at things, especially if you're trading Forex, is it makes sense to use the time to get refreshed, rested, and ready for the next week. No need to trade, risk trading, and basically get stuck in low liquidity chop, end up ruining your Thanksgiving weekend with the family. It's really not worth it. We would strongly urge everybody to focus on protecting Zen capital and just taking 4 days off and enjoying some time with the family. Now, on the data front, what have we got? We've got Draghi speaking on Monday. We've got some RBA on deck on Tuesday. We got inflation report hearings out of the UK on Tuesday. Apparently there's going to be some Brexit news when we open up this week, so heads up for that. And then on Wednesday we've got that forecast statement out of the UK. We got durable goods, we got the weekly job numbers, crude oil inventories, and we have the FOMC minutes, which should be particularly interesting, right? And just still remember that the market is really not pricing in the rate of hikes that the Fed is trying to signal, right? So there's a lot of potential moves to come with that. Now, where are we, and what's going on? Now, as we discussed, the market has continued to, we've been warning about that breadth hasn't really been that great in the market, and despite the action, it really isn't getting better. So stranger things have happened. Anything can happen. The market could skyrocket and, go to all-time records and continue to beat all those records of no pullbacks, whatever. But what we're seeing is clearly not the sign of a strong, healthy market at highs. How did we close last week? Well, ultimately, I think as we discussed on Friday in the open, everybody was getting excited, and we said, really keep an eye on these weekly candles, because essentially, right, look at the ES. ES closed slightly down, so a lot of fanfare, but really nothing happened. Right? Nothing happened. We slightly closed down, so we'll have to see where we're trading. Breadth again is still not great, so would not be surprised to see the market try and take out those highs. But unless we don't close above this level from a weekly close, which then would open up the room for more grind higher. Unless we can't close above that level, then we still think the path of least resistance is for the market to try and come down and have some kind of a healthy correction, at the very least, back into this 50 DMA, towards this whole 2440, 2400 range. So that would be our base case on the ES. If you're looking at the NASDAQ, even though we had that crazy day, I don't like to use the word crazy, but still it was a bit silly day. We closed the week pretty much where we started. So the difference on the NASDAQ is that we're above that 6,000, so we're still holding bid. It's stronger than everything else, but still, just keep an eye on last week's highs and the week before. Unless we don't get above those and hold above those from a weekly close basis, then path of least resistance, we would suspect, at least for the NQ, as a pullback to the 6,000. And then if we can start to get daily closes below that 6,000, then the 50 DMA will open up. And if you look at the YM, right, so very similar action. You see, we're really not doesn't look like really bullish, uber strong and high. It's just a little bit heavy. So that's pretty much where we are on the indices, right? That's what we'd be looking at. That's what we'd be focusing on. Then the other thing, again, as we talk about rates, as we talk about all these things, of course, the USD is going to come into play, right? So looking at the USD, and we've seen some fairly interesting action across the board. In terms of DXY, we're really at a key inflection point, right? And the best way to look at it as far as we're concerned is to get on the daily with that 200, 150 DMA on the chart. And you see how it's just hovering right at a key inflection point. So here the bulls and the bears are fighting it out. So the bulls got very, very excited at those highs and we couldn't get any traction, right? So we pulled back below that 94.40, and this is really the key. The bulls need to hold this. See how it's trying to find support? You had that positive daily close. The bulls are trying to hold this. They need to hold it above these two moving averages. They need to force the 50 back above the 100, right? To try and take another stab at those 94.40s and try and take these highs out strong, right? Finish strong. The bears are going to keep the pressure on. A bounce here, I would suspect, would be welcome for the bears because we like to see healthy markets in general, right? So the bears are probably waiting for a little bounce to get a chance to sell back into those 94.40s to go for the, to go for the kill and break it back down. But as far as we're concerned, what we would say in terms on the weekly close, unless you don't see a close above the 200 or a close below this level, it's still likely going to be very, very choppy as the market looks for clues out of the Fed, out of DC, etc. And this is really where the game is played. But I think the most important thing here is that the bulls really do not want to lose this level going into the week. So this is really, really important, as it looks like it had a strong chance to rally and everybody was looking for it to rally, especially after it put this positive daily close, and it's really not getting any traction, right? How does that translate into, the two king and queen, or whatever you want to call it, yen and euro? Well, on yen, we got a nice move back at the 112. Those who follow the blog or who follow the morning updates will remember that we thought that we had two very nice opportunities, both in terms of longs on euro and short on yen, which is essentially same trade, right? But that failure to hold the break above 114.50s, we're calling for a move back into neutral to the 112, and that's done, right? So you see, in a very similar fashion, now that that's done, we're at that key zone also on the yen. We're back in this neutral zone, and we've got all these moving averages trying to support in mid-range. So if this can hold, then you would expect to see a bounce, and this could get very, very strong again because you've got a little bit of an air pocket here. But if it breaks, this could get very, very ugly very, very quick. Now keep in mind, similar to when crude was pressing those highs here, you've got the market is really record piling in on the short yen trade, right? And that means short Japanese yen, so that would mean USD JPY higher, not lower, right? So the market is really caught off guard here. So especially if we get a little bit of traction to the downside, we really would not be surprised to see this accelerate back into the 109.50. So that's something to watch. And in terms of Euro USD, again, we're talking about how we thought that inverse head and shoulders everybody was looking at was almost too good to be true, right? And that we would be very, very cautious because the market had a chance to sell off hard, and the fact that it moved back inside our shaded area gave us a little pause, and said, probably, the asymmetric risk reward is to try and play for the upside, especially if this holds. There's a good chance we make it back to mid, and this could easily squeeze market, which is really positioned short, all the way back to the top end of the range. But bottom line, we're right back here in the middle of the chop zone. But you see how it's the opposite to the DXY or to the yen here. Now these moving averages are trying to cap it. Now it's holding, euro's holding much nicer. So it's holding, how would I put this? So it's managed to break above the resistance, whereas DXY is holding above the support, right, in terms of those moving averages. So it's going to be an interesting fight. But again, all the charts are lining up fairly nicely, fairly tradable, but very, very interesting time for the USD going into this week. Now, in terms of crude, a lot of people writing in asking about crude. I'm sorry to disappoint, but as we said, essentially at those highs, the market's really positioned long and tends to always get caught off guard. And we said, the asymmetric risk reward bar somebody launching a missile or declaring war, is to trade this to the short side for a move back into the 55s, and that's what we got. Now we're getting whippy action, but on the weekly, it's still all about that 200. But right now, we would suspect the market is just going to be in seek and destroy mode, trying to take out as many stops, try and ruin as many people's dreams and hopes and aspirations for a good trade, as things seem to be heating up in the Middle East, and as we get into this OPEC meeting on the 30th. But if history is anything to go by, you would expect this to try and hold bid, try to press higher, and probably get something disappointing on the 30th and see another puke. But it's a little bit early. We'll update in next weekend's outlook. But right here, a lot of chop, similar to, you see how we're stuck in all these charts. We're stuck inside the 200 and the 50 and the 100. Market is really chopping sideways, waiting for direction, right? In terms of gold, as everybody was starting to call for the death of gold again, right? At least shorter term, as we like to remind players, is that market likes to make a fool of as many people as it can most of the time. And you see that we had all those days where gold was just puking towards the back end of the day, catching everybody off guard. So everybody got used to it puking at the end of the day, and then on Friday it just rallied up just to just for good measure to confuse as many people as possible. We're not going to get sidetracked by the short-term gyrations, right? And our base case is still the same. As long as we don't get a daily close back below this 200 on the daily, would not be surprised to see that even intraday try to whip and take out stops below the 1250. But our base case is still the same. As long as we don't get a daily close below this 200, this is still a lot of choppy actions to try and build a base and rotate back higher as equities correct. So we're not going to change our view. And right here going into the week, 1300 is going to be pivotal, bull bear line inside 1350. 1300, 1250 range. This is the broader range, and the 1300 is going to be the pivotal level for bullish or bearish, right? So consider, if you're still looking at this range, the way we're looking at it, the way we consider it is around 1300 is neutral, right? Bit bullish, slightly bearish, but still here trying to build that base, okay? And then one last thing, which I got some emails coming in asking to review, and again, I'm afraid I might disappoint on this too, are the ZBs, right? So the ZBs, not an awful lot is happening. It's a very, very difficult read, and the market's just waiting for direction, right? Just waiting for the next catalyst. And as we said, right, it's just stuck, right? It's stuck inside this area, and unless we get a daily close outside, it's going to be very, very difficult to get some traction around these 152s. We ultimately think it's going to try and break down, but right here, it's just a very difficult call, right? So unless you get a sustained break above 54s or below this 150s, it's tricky. The problem is, if you step a little bit back on something like a weekly too, you've got the same thing, right? If we break higher, you've got an even bigger choppy range, right? The market is just going nowhere. So step back and understand the context, right? Remember this when we were looking for a generational sale on the bonds, right? Essentially what happened is we puked back down into the beginning of this year, right? And now we're stuck. Everybody's trying to understand what the Fed's going to do. We haven't really had much clarity, and the market is just in wait and see mode. So unless we start to get more and more clarity, right, out of Washington, out of the Fed, it's not surprising that the market isn't breaking out. And essentially, the Fed's trying to tell us that they're going to raise, and the market's not really pricing that speed of raising in. But the market is still waiting for something out of Washington, and objectively, whether you're pro the current administration or against, it doesn't matter. Nothing has come out yet, so it's not surprising that the market is wait and see mode. So we'll have to wait and see what happens. Okay, it's just the market's just waiting. Okay, so I hope that was useful. Again, a couple of people wrote in again saying they like the weekly videos, they enjoyed them. So always really happy to to get some feedback. Thanks for sharing. Thanks for liking. It's just refreshing to know that it's not just me talking into the mic and nobody on the other side. So again, thank you so much, guys. Have a great week. Have an awesome 4-day weekend if you can. Would strongly urge you to take some time off, enjoy the family, enjoy some good food, and chill. And if not, I'll catch everybody back on next Sunday for the next update. Have an awesome one. Thank you so much. Bye-bye, guys.